Today, we are diving into one of the most perplexing and persistent puzzles in finance, the low volatility anomaly. It's a phenomenon that challenges what many of us learned in our first finance classes. It is a phenomenon that challenges what many of us learned in our first finance class, and it reveals how human behavior can sometimes trump pure logic in the market. We'll uncover why boring stocks can actually be outperformers, discuss the theories behind this strange market behavior, and then most excitingly, we'll build a simple Python backtest to see if we can prove the anomaly exists with real data. Let's start with what the textbooks teach us. Every introductory finance course, often drawing from the capital asset pricing model, drills in a fundamental principle. To get higher returns, you must accept higher risk. To get higher returns, you must accept higher risk. Risk in this context is usually defined as volatility, which is the ups and downs of a stock's price. The theory logically states that if you take one more uncertainty, you should be compensated with a higher expected return. So, a portfolio of exciting, volatile stocks should outperform a portfolio of stable, less volatile ones over the long run. So, this makes perfect sense, right? However, for decades, researchers and practitioners looking at actual market data have observed something truly strange. The theory doesn't hold up. Safer, less volatile stocks have frequently produced better risk adjusted returns than their risky counterparts. This is the core of the anomaly. The low volatility anomaly is precisely this empirical finding. Stocks with low historical volatility have shown surprisingly higher returns, often outperforming high volatility stocks, not just on a risk adjusted basis, but sometimes even in absolute terms over long periods. So let us use the marathon tortoise versus a sprinting hare analogy. High volatility stocks are the hare. They're exciting, glamorous, they sprint ahead in short bursts, but they also stumble and fall back dramatically. They cause a lot of stress. Low volatility stocks are the tortoise. They're often seen as boring, unexciting, just plodding along at a steady, consistent pace. The anomaly is the observation that over the full course of the marathon, the tortoise's consistent pace and avoidance of major stumbles often leads to it winning the race, and with far less stress along the way. That's the low volatility anomaly. If this phenomenon is well documented, why doesn't it simply disappear, as smart investors would try to profit from? The reasons are complex, rooted in human psychology and the structure of financial markets. Firstly, we will look into behavioral biases. Many investors exhibit a lottery ticket preference. They're irrationally attracted to high volatility stocks for the same reason people buy lottery tickets, the dream of a massive life changing payoff. This causes them to overpay for risky stocks and neglect the stable ones. There is also the representativeness heuristic, where investors get caught up in exciting narratives about glamorous high growth companies. We tend to overestimate their potential and ignore the steady compounding power of boring but profitable businesses. Secondly, structural and institutional constraints play a huge role. Most professional fund managers are judged against a market benchmark like S&P 500. Holding too many boring, low volatility stocks can lead to underperformance during a roaring bull market, potentially putting their jobs at risk. This creates an incentive for them to buy riskier stocks, leaving the low volatility stocks underowned and potentially undervalued. Finally, there is leverage constraints. Many investors can't or won't use borrowed money. So, to target higher returns, their option is to buy higher beta, higher volatility stocks, further driving up the prices of these riskier assets. So, that's enough with the talk. Let's see this anomaly in action with real market data. We'll run a simple backtest in Python. Our goal is to create two portfolios, one of the low volatility stocks and one of high volatility stocks, and then compare their performance. First, we're grabbing the current constituents of the S&P 500 and downloading over a decade of their historical adjusted closing prices. We've got data for hundreds of stocks, which is great for robust testing. Now, for the backtest logic, it's straightforward. Once a year, we look back at the past year's volatility for every stock. We'll then pick the 20% least volatile stocks for our low volatility portfolio and the 20% most volatile stocks for our high volatility portfolio. We hold these for a year and then rebalance. So here we saw the low volatility stocks, and here we saw the high volatility stocks. So let's run this. So now that we have the returns of the low volatility portfolio and the high volatility portfolio, let's plot their cumulative performance against the S&P 500 benchmark, represented by SPY. And there it is. Look closely at the green line, representing our low volatility portfolio. Over this period, it's not only kept pace with or even outperformed the broader S&P 500 during some periods, but it's done so with remarkably less dramatic swings. Then the red line, which is our high volatility portfolio. Even though it caved in a bit at the end, it still remarkably performed well during these years. To quantify this, let's look at a few performance metrics like the annualized return, the annualized volatility, and the Sharpe ratio. So, if we look at these values, we can say that though our low volatility underperformed than the high volatility portfolio, it still had a better risk adjusted return, which is denoted by our Sharpe ratio, than the base S&P 500. So, the numbers confirm what the graph shows. Our low volatility portfolio often delivers similar or even higher returns than this S&P 500 base ticker, but with significantly lower volatility. This leads to a notably superior Sharpe ratio, meaning you're getting more return for each unit of risk you take. Even though our high volatility has a higher Sharpe ratio because it has a very high return compared to the both base and low volatility. Compared to the base one, our low volatility portfolio performed very well. So the boring stocks can truly be the better investment on a risk adjusted basis. The results from a backtest are clear and consistent with decades of academic findings. The low volatility portfolio generates competitive and offers superior returns to the baseline, and it achieves this with significantly lower volatility, meaning a much smoother ride. This translates to a superior Sharpe ratio, proving that on a risk adjusted basis, these boring stocks can be better. The low volatility anomaly shows that sometimes the best offense is indeed a good defense. By consistently avoiding large drawdowns and the dramatic swings of risky stocks, the tortoise can sometimes and often win the race. This is the essence of winning by not losing.